My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there is Nick O'Gorman. I apologize. I haven't had too much coffee just yet, and I should. Nick, I reached out to you because I like a lot of your tweets, and I think focusing on dividend investing is underappreciated, especially when you're in a market like what we are in now. So introduce yourself to the audience. Who are you? What's your background? That you're interested involved in markets, in investing, and why dividends in particular?
Yes, sir. Okay, Michael, thank you. First of all, I want to say thank you for reaching out to me and inviting me on. It's an absolute pleasure and honor to be here. Very excited. Yeah, my name is Nick O'Gorman. I'm 36 years old. I'm originally from Yonkers, New York, and I'm a physical education teacher, and I'm also a dividend investor, and I also invest in real estate. So how this whole journey kind of began for me was, just to back it up a little bit, my story is very, very involved and it's kind of long. So I'm going to kind of give you guys a little bit of a snapshot so I don't linger on and I don't go too long here. But, we grew up, me and my sister, my father, and my mother, we grew up in Yonkers, New York. We grew up middle class. And as a kid, my father was a huge influence in me and my sister's life. Very, very big voice in our ear as far as always trying to save our money and just instilling those values of always being willing to work and always be willing and understanding the value of saving your money. So all through my years as a young boy, I mean, we grew up on kind of the rougher part of town. We had our family house was there from way back in the day. We didn't grow up in the best neighborhood, but, not much going on there. Our neighborhood didn't have much going on there. I could just remember as a little boy, as a young man, always thinking about ways to, make money. And I had my dad in my ear about saving. So that's kind of what I did. And it was scarcity, but I rather had that than nothing. I didn't know anything about investing. That was very, very foreign, but we always knew to save our money. Growing up, I did a plethora of jobs. Whenever I had an opportunity to make money, I did. And that grew into me as a teenager and me as a young man, as an adult. Fast forward 2016, I got my career as a phys ed teacher. And, I kind of kept going with that idea of continuing to save my money. Fast forward a little bit, 2018, my father ends up getting sick and he passes away. And at that point, I was smart enough that I always saved my money. So at that point, I had a whole bunch of money. I just always saved it. So when he passed, it was very hard for our family. It was very tragic because it was very unexpected. And, at that point, between the money I had saved just for being a kid and working, and then a little bit of money that he left us as a family, I was at a point where I had to make a decision. Do I want to make something of this or not? So at that moment, I was 31 years old. After his passing, I decided that I wanted to do this. And I was going to take the opportunity and the legacy that he left, and I'm going to run with it. And what I did was I just learned as much as I could at that point about personal finance and how to grow my money. And I had to find ways to be in this investing game, but also work my 9 to 5 and fulfill that obligation of being a person that had a career. So I had to find a style that kind of fit that whole kind of deal that I had. And that's when I found dividend investing. And it wasn't right away. I went through the whole deal of learning about, retirement funds and index funds and all that deal. And then I came upon dividend investing and I really liked the idea of the passive income. I like the idea of, yes, I understand that dividend investing is a return of the overall investment, but I like the idea of getting it in the form of cash flow. So instead of having to sell shares like in an index fund, I really like the idea of receiving that cash flow, but still have the underlying asset and still holding the shares. So that was very attractive to me. And then all this time, as I'm learning and everything, I'm just starting to get my feet wet. So I'm just building and building and building. I'm still learning. At this point, I'm living up in Connecticut, but I'm still working in New York. So I have an hour drive back and forth every day. And then I would just, I would listen to podcasts and I would listen to audiobooks and I would watch YouTube videos and I just immersed myself and absorbed as much information as I could. And all the meantime, I'm continuing to work and any opportunity that I have at work to make more money or to fulfill more hours, coaching a sports team or teaching at night or whatever it was, I just continue to do it because that's what I've always done. And I was able to build and build and build. And fast forward 5 years of doing this since my father has passed, fast forward 5 years, I am where I am now. I'm teaching other people how to do it. And as of right now, my income from just my dividends alone is just approaching almost $15,000. So I'm proud of that. I'm happy for what I've done so far. And to me, this is only the beginning. So sorry if I ramble a little bit. That's kind
No,
of
no, that's good. And I'm sorry about your father's loss. I know that pain myself in '08 when my father passed also unexpectedly. You mentioned grow up in kind of a rough part of town in Yonkers. Do you think that made you more attracted to income producing assets as opposed to capital appreciation, just because of your own upbringing, wanting to see cash flow?
Oh, no doubt. I mean, I think that definitely influenced me a lot. I mean, as a young man, I was a knucklehead. I mean, I wasn't getting into trouble, but I was outside and I was hanging out with those guys a lot. And from I'd say from 10 to 13, and then those years in middle school, I saw a lot of things that probably shouldn't have saw, and all those things. So that was a big influence for me. And then that was around the time that I started to get very, very interested in making money. And because I saw those things, and it wasn't the best environment for a young man, I said to myself, I don't want this. I want better than this. An absolute influence on me for sure.
So you talk about the focus on saving, and then 2018 was sort of where a lot of things changed for you. Did you ever kind of, as you were saving, say to yourself, "Well, I'm not really making too much interest in the bank, right? Just because we had this era of zero interest rate policy, and it was hard to really save and make money, certainly after inflation." What did you ever, as you were saving, think about you know the savings rate, or was it more just focusing on building up that cash reserve?
You know what, Michael? That's a great question. And what it really was I all I knew was to save. The idea of investing, or just the thought of the stock market, I didn't even know existed. To me, I just thought that everybody saved. And, just such a scarcity mindset. But I honestly really thought that whoever was a millionaire out there, or whoever did this, they did it through a business or just saving their way to $1 million. I had no idea what investing meant at all.
So why focus on the dividend equity side versus getting income from fixed income from bonds? What made you go more towards the stock side?
Well, I guess it was just some of my first influences when I was learning. And I like I said, I really like the idea of the money coming in and then still holding on to the underlying asset. And also, call me crazy, but I like the idea of investing in great American companies, that I can ride the waves of their not so good days, and ride the waves of their great days, and take advantage of those selected times where they're kind of unfavorable and people don't like them. And I learned that very, very early on, that you want the positions and you want the stocks that people don't want at the time. Take advantage of those times and ride them up and enjoy the good times too. To answer that question, bonds are great, and bonds are a good defense in a portfolio for sure. But for me, I just like that idea of just sinking my teeth into those great American companies, and being a shareholder of those brands.
So actually, that's a good transition to some of the stuff that's been making the headlines more recently. I mean, I think anybody would be hard pressed to argue against the idea that Verizon and AT&T are great American companies, right? I mean, they drive so much of what we do. They're very big dividend plays, and their stocks really haven't gone anywhere. Total return different, but obviously the asset itself has not done so well. So, talk through to the audience how you identify not only what a great American company is, but what's a great American company that will grow after its dividend distribution. There's a big difference. I think a lot of people, when they think about dividend investing, they're just looking at that juicy yield number, but there's more to it than that.
Oh, for sure. That's a great question, Michael. Typically, what I do as a dividend investor, I look at 5 metrics, and I want you guys to kind of identify and follow me through here as far as my order. Okay. So the first thing that I look at is called the PE ratio, and that's the price to earnings ratio. So that's the share price to the company's earning per share. When we're talking about PE ratio, typically what I do is I look at the S&P 500, and that'll give me an idea of, are we in a state of overvaluation or undervaluation? Where are we at with the overall market? But then I'll look at individual sectors, right, to see where we're at with that. And then what I'll do is I'll go inside, and then I'll see what are my positions in those sectors, and then I'll look to attack some undervaluation. That's just one piece of the pie, though. Now, PE can kind of be miscued, because if the company just acquired another company, their debt goes up, right? So their earnings there could be a little bit misled. So there's a lot of things that go into PE. These are just the broad idea of what I look for. So that's number one. Number two is our payout ratio, right? We're dividend investors. We got to look at this as, okay, you're looking at this as a company, right? The same thing as if you were the owner. What's your money coming in? What's your money going out? Same deal in real estate, right? So when I look at the payout ratio, I want to know how much of a percentage of the company's income, their net income, are they paying out to me as a shareholder as a dividend, right? And when that number gets a little bit too high, when we're looking at 70% or higher, I'm not really getting too interested anymore. Okay, we're getting into that danger zone. So you want a company that's making money, but they're not giving the house away to you as a shareholder. Okay, so that's number two. Number three is going to be your dividend. Now we're going to focus a little bit more on the dividend. So now you see that in my deal here, my criteria, I'm looking at the company first. I'm trying to see what is the overall health of this company. So I'm getting a little bit of a screenshot with the P ratio and the payout ratio. Now let's go into the dividend. What do you got on the dividend? First thing I'm looking at is the history, right? I want to know how many consecutive years have you been paying this thing? Okay. Now, you also want to know in the last 5 years, this is number four, in the last 5 years, how much has this dividend grown? So going backing up to number three a little bit, as far as increases, I like to see 8 to 10 years. That's where I'm a little bit more comfortable. Depending on the company, I can go down a little bit more. If it's a newer company, 5 years, but I want to see some kind of establishment here. Okay. So 8 to 10 years, we're getting to that comfort zone for me. Now, as far as 5-year growth rate of that dividend, I'd also like to see a little bit of growth. I want to see at least 5 to 8%. Okay. Now, again, other things going on in the company can miscue these numbers or hold them back a little bit, slow them up. So it's always wise to know the internal news and what's going on with each company you invest in. And now the last one, number 5, that would be the dividend yield. Now, to me, that's the least important of the whole deal. And the dividend yield, I like the 3 to 5% is where I'm pretty much looking. And overall, my portfolio of about 40 positions, we're looking at about 4.5%. So I like to stay in that zone. But like I said, the most important thing is to know the overall investment. You got to look at it as a company. You wouldn't just blindly spend your money on something you don't know, or you shouldn't. So you got to know the overall health of that company. Are they making money? What kind of money they have going out? What's their debt? What's their free cash flow? And then you decide, go through those 5 criterias and see what you want to do from there.
Well, what I like about the way you're framing that is that you're talking like a true investor as opposed to a lot of these kind of zero DTE quick buck trading things that you see. It's like I put out that tweet the other day. Graham and Dodd has nothing to do with gamma squeezes, right? And that's what real investing should be. It should be about having that kind of longer term framework. Now, I'm going to assume, like everybody else, you might be tempted, despite your framework, to focus on high quality companies, dividends, and do a fundamental analysis to take a couple of bets on things that are just mooning, for lack of a better way of saying it, like we're seeing with some of these AI names this year. When you're in environments like this, you feel that FOMO yourself. I mean, that's the reality is dividend investing is conservative, right? It's not going to have the kind of runaway gains like you see with some of these NASDAQ stocks, and it's human to want to participate when things are doing that. But do you stop yourself, or do you try to stay true to your knitting, or are you maybe playing a little bit outside of that?
Well, Nicole, typically what I do is, that's a great question, man. You got me thinking, dude. What I do is typically I stay true to my dividend portfolio. But in an account like a Roth IRA, I'll load those up with my index funds and I'll have exposure to the tech sector and things like that. But as far as like very risky AI plays and things like that, I don't necessarily dabble. I will dabble though a little bit against my dividend criteria based on the company, right? Like you said, like Verizon, AT&T, Altria, MO, some of the mortgage REITs, the mortgage-backed REITs, GNC, right? These are very risky plays. What I would do, and I did earlier on in my investing career, is I took some bets on those plays, and I still hold Verizon and AT&T and AGNC. Sorry, I look at it as those are kind of like my risk plays, and that's kind of where I manage my risk. But and those are risky, just like we were talking about Verizon and AT&T, riddled with debt, riddled with absolute crazy debt. Right, they're over their heads times 10. But for me, I have conviction because I see a longer term play in those. I think that technology is just going to oversee anything that anyone is really anticipating in the next 10 years. So I think those two, I'm hoping that they're going to move and they're going to transfer into this more technological state that we're going to be in. I think that Verizon is a little bit better managed and than AT&T, but as of right now, I'm going to hold on to both into the future. We'll see what happens.
Okay. And those are cases where there's like specific dynamics around this, whatever, some kind of piping issue I just see on the headlines, right? So that could pass. But, once you've constructed your dividend portfolio, presumably you're just sitting on it and waiting and getting those checks coming in. As you get more capital yourself, as you're, taking some of your income from your job, are you putting it equally across everything in your portfolio? Or are you deploying it in new dividend names? What are you doing with new cash that's coming in outside of the dividend cash?
Great question, Michael. Another one, man. You're hitting them on the nail today. Yeah. So typically what I do is I set a percentage to go into the dividend portfolio. We're talking about new cash, right? New funds. So typically right now I'll do about $1,000 a month just to keep it moving a little bit, reinvest the dividend and just keep the wheels churning. And the rest of my capital, I'll max out my Roth IRA and then everything else goes into my real estate funds. And I didn't really touch about it too much in the beginning, but I'm a real estate investor as well. And I have one rental right now. So I'm kind of in the beginning stages, but ultimately, my ultimate goal is to build the dividend portfolio to a big enough base where I always have cash flow coming in and I'm comfortable with that. And then, I can scale more into my real estate business. So ultimately, the ultimate goal is to have more real estate while the dividend portfolio grows kind of as this cash machine in the background when I need it.
You put out a great tweet about Amazon Prime Day around the idea of, don't spend too much there relative to what you're putting to work in your investments. Talk about the role of frugality. One thing is to have a nice dividend portfolio and good cash flow, but you want to also reinvest those dividends back into those stocks, presumably, just like you're taking new cash and pulling in your portfolio. So you see the income rising and you feel like, maybe I could spend a little bit more. Are you still living the same sort of life in terms of your own spending habits, or are you upping things, or just saying to yourself, you know what, I'll spend later, let me just keep building now?
Instrumental, dude. Instrumental to my whole journey. And those were the two. Just like you said, the idea of increasing your income, always be willing to increase your income. And then also always be willing to live below your means and have your living expenses be low. And those have been my two absolute advantages. I mean, like big time advantages. And pretty much my whole adult life, I've practiced frugal living. So maybe that's also why I like dividend investing so much, because I've never in my life had chunks of money come my way like that. I've always had to work for everything since I was a young man. So maybe that's why, but just going back to that. But yeah, so that's the idea there. And I'm sorry, can you
No, but it's hard, right? The temptation is there, right? It's like, you mentioned you want 12, 15,000.
Oh, yes.
Right? It's like,
right.
You see the numbers going up and you're like, oh, that means I can buy more. I can get.
Right. Got it. Sorry, Michael. Yeah. That's, like I said, that's been a huge advantage for me. And my whole adult life, I've always kept my living expenses the same. So year after year after year, my income has gone up as a teacher and all the other extra work that I did, and my living expenses would stay the same. So I just kept widening that gap of margin between the money that I need and the money that I can invest. And that's how I've been able to, invest in real estate, grow my dividend portfolio, because I've been living so frugally for so many years now. And I've busted my behind, but increasing my income. I've worked day and night for 5 years. It's definitely something that if you dedicate a percentage of your life, we're talking a few years, it's been 5 years for me. So say 5 to 7 years of your life, which is a small percentage to set yourself up for life. I think that's a pretty good trade-off. And it definitely helped me for sure.
The timing of it being 5 years is interesting because obviously in the middle there you had COVID and then meme stock investing and YOLOing and all this stuff. What were you doing from 2020 to 2021? Were you changing anything about the way you were investing your portfolio, or were you seeing it as a tremendous opportunity? It doesn't sound to me like you went the sort of route of a lot of the newer traders that happened to come in just as things were about to turn at the low in March of 2020.
No, I was already in. I broke in like in 2018. I started investing and learning. And like I said, I got my feet wet as I learned So we're talking, yeah, my dad died in August 2018, and then I moved in November. So around that time, yeah, that's when I started learning, late 2018. So I was already in, and I already probably had over 100 grand in by the time that COVID hit. And I remember, it's funny, I remember, and I always tell this story to people. I remember I was on the corner in New York City. I was on a corner walking across the street, and I'm looking at my portfolio, and I get to the other side, and it's in the morning, and we're in the midst of COVID. We're like, we're in the trenches. Like the first few days, and my portfolio is down like 19, 20%. I mean, $20,000 in a day. And I'm looking at this, and I'm still green. I'm still a new investor at the time, and this was like, this was the first real test to like, all right, you got this or not? Do you want to do this? And I'm looking at it in a minute. It's going 20,000, 22,000. The next day we're down 27,000, 30,000. So I'm like, man. And then I decided to put like another, it was like 30 or 40 grand into the portfolio. And I was buying all the quality in my portfolio. I was buying the McDonald's shares and Starbucks and Johnson & Johnson, Pepsi at like ridiculously low prices at D. And, they've run up since then. I still have all those shares. So that was really like, that was a real key point in my investing career, because that was like, it didn't shake me up, but it gave me that experience that I needed to say like, all right, this is for me. I can do this, and I can see myself doing this forever if I can stomach this, what I'm looking at right now.
Like if you're going through hell, you might as well keep going, as the old expression kind of goes on that. All right, so let's get into some of the weeds as far as the portfolio itself. How many names do you typically own? And then, it sounds like it's a very blue chip, high quality type of portfolio. What helps you determine where to put more capital to work in? I mean, are you doing simple equal weight? Are you trying to play with different weightings? Talk about the construction point.
Okay, great point. Great point. Well, typically what I do is I'll look at all 11 sectors of the S&P 500, and then I'll see what is undervalued. And then, like I said before, I'll go in and I'll see my positions in those sectors. And that's when I know what I'm going to start to attack with some new capital, right? But, typically, I mean, a few months ago, let me tell you, Michael, a few months ago, my portfolio was very, very overweighted. It was widely overweighted. And I was working with close to 60 stocks. And since then, I've evaluated my portfolio, and I started making some cuts. And I've cut it down to about 40. So I feel comfortable with the 40. I feel like I can manage that. And like you said, it's all blue chip stuff. We're talking like Johnson & Johnson, AbbVie, Starbucks, Pepsi, Coke, all those things. Oh, Realty Income, that's my number one position. And then typically in my Roth IRA, which is tax advantage, I'll hold my index funds, like my S&P 500, my international. I have a REIT fund in there, and that's where I'll hold all my REITs as well. My real estate, my trust, all my real estate trust investments are going to be inside my Roth IRA as well. That's typically what I do. I run the portfolios like that. I feel better now because what I'm doing is I'm giving a bigger allocation to ETF SCHD, which tracks more of a broader market with dividend stocks. And I like their criteria. I like how they manage it. So I'm going to give them a little bit of my portfolio to manage. I like to see about 10 to 15% into SCHD, and then I'll manage the rest. And I'm kind of getting to that point where I want everything to be solid. I want everything to be set up, and then the portfolio can run itself. I can manage it. I can use it to see what's undervalued, overvalued. And then I can also start to focus on real estate as well.
So what was the criteria on cutting those 20? Because that's, everybody always tells you, what makes them want to buy, right? But if you bought and then you're saying, okay, I want to make this a tighter portfolio, you got to have some common theme across why what you're reducing. So what were some of the things that you think through in terms of causing something to get kicked out?
All right. So the first thing I look at is there any overlap in sector in my portfolio? So say that I'm a little bit heavy in healthcare. I'll take a look at what I have, and I'll see what do I want to hold like forever. That's always my lens of holding forever, but then making some changes as the market changes. I did have a lot of my portfolio. I did have some spec plays from when I first began. I had some business development companies and some REITs that I felt weren't really part of the portfolio anymore. I also see if a payout ratio is getting a little bit too high, and they're starting to run that dangerous zone of maybe a dividend cut. I take a look at what the company is looking at. Is it beneficial for them to cut that dividend or not? Are they going to benefit from it? Are they going to change things around long term? All these things you look at. But I think that also, like I said, the allocation for per sector, just to keep your diversity at a certain level, you always want to take a look at if you have any overlap, and you know see if you want to condense, or what are the overall healths of those same kind of companies in the same sector.
And certain sectors are obviously more prone towards dividends, right? I mean, utilities, consumer staples, healthcare, less so tech. I'm going to make the assumption, but maybe I'm wrong on that. Talk about kind of more high octane dividend plays. I mean, you can have blue chip, well managed companies that, still have some real crazy growth potential and are moving, but still paying at a nice dividend.
Oh, for sure, for sure, and that's like a perfect marriage, right? You have a stock that has a decent yield and then also growing at a good rate, and that's the perfect marriage right there for a dividend investor. Hard to find, but there are stocks out there. There's a healthcare stock called Gilead. They develop healthcare drugs, and their growth has been fantastic over the last 5 years. And they pay, I want to say, between 3-4% dividend. So something like that. Or all of the Lowe's and Home Depot's fantastic growth. Another one that I'm a big fan of and I have a lot of money in is Starbucks. I love their management. Howard Schultz, who's the former CEO, is one of my favorite CEOs of all time. Big fan of them, but it's great. It's great to have growth. It's great to have medium yields. It's even great to have a little bit higher yields, like a company called Altria, MO, right? That sector, the sin stock sector, Philip Morris, another one. It's always good to have all kinds of yields going in, but you don't want to be too high, and then you also don't want to be too low. You want to have that middle ground that you can grow, but you can also sustain some kind of income as well.
Okay, so we got into a lot of different parts of the dividend side of things. Do you find that there are times when you almost have a gut feeling that something is going to go bad with the market that causes you to maybe reduce or raise some cash? Are you doing anything kind of at the periphery to counter, broader feelings about the market, or are you just always staying invested long term? You don't care about the wheels and
Yeah, I'm a long term buy and hold, Michael. So that's my outlook. And like I said, every time that I research a company or I'm looking to make an investment, it is for life. So it depends. I mean, like I said before, when things happen and you move with the market, but my consensus in the beginning is I'm going to invest in this company for life. It's always long term for me. And I feel that the long term outlook is the easiest for someone who's playing the game like me. It's got other things going on in life. I'm a career person, I'm a family person, and I need to focus on those things as well. So the long term buy and hold for me has worked, and it's given me the ability to also just not obsess over, dividend investing, to step out and also, build my real estate and work on other things that could also prosper my life total.
right? I think it's an important point for anybody that's a newer investor or trader. Unless it's your career and your profession, you should not view it as a hobby. You should not view it as a side gig. You should take it unequivocally very seriously, but you shouldn't be spending all of your time on it, because if you're a true investor, you have time, right? I think there's a perception out there by traders and investors that they always have to be on and know what's going on in the here and now, as if any of that matters for their returns. And all that ends up being a distraction to actually generating income from things that they can control.
Yeah, I agree with that. I agree with that. There needs to be a certain level of effort, and especially early on. I mean, I spent a lot of time early on learning these things, and really understanding personal finance. But you got to get to a point where it's part of your life and it's there. It's just like anything else you do. You go to work every day, but you don't obsess over your work when you come home. So same kind of deal with investing. It's got to be taken a little bit more serious than going out there and playing around the golf, but it can't be something that overtakes your life. And that's, for me, that's important, because you want to step out and you want to do other things. And to me, one thing that I never understood about investing, and from the beginning, I never understood this. I never understood like the camps of investors. It's either you're all stock market or you're all real estate. Or you're
But
all,
yeah, like tribalism, right? From that standpoint.
right? You know what I mean? I never really understood how it was broken down in those camps. And for me, I'm in the middle. I'm stock market. I'm real estate. I run Smart Net Worth LLC, so I'm business. Everything is I got my hands in everything. So, in my opinion, never be afraid to get out there and do other things. You're not just a stock investor. You could be an entrepreneur. You could be a whatever. You could be a syndicator. You could be a landlord. You could be a flipper. You could be a burr. You could be a buy and hold. It doesn't really work in the realm of just one. And we talk about being abundant and allowing your life to prosper and putting yourself in those positions to win and accept opportunities. That means that you got to be in every camp, right? Because you never know when that opportunity is coming. So put your hands and your fingers in every bowl.
Yeah, I mean, that true diversification is more than just a portfolio, right? It's about where you're spending your effort in general. Okay, so you're obviously building out your own brand on the dividend side. You've got your newsletter. You're building out content. Talk through the types of stuff that you put out and tweet, because again, if you're going to be focusing on blue chip, high quality names, there might be only so much you can say about them, right? But you still got to kind of be out there, right, in terms of the content. So maybe it's more processed, maybe it's something else. But how do you keep the material fresh when you're arguably in a part of the marketplace which works, but can be kind of boring, which is good in its own way, but also makes it hard from a brand building perspective to keep flowing?
Oh, absolutely. For me, my message is always that anybody can play this wealth building game. And, I always try to instill that in everybody. I use myself as an example. I'm just a regular guy. I'm a phys ed teacher and a regular kid from the southeast side of Yonkers, New York. And, I'm doing it and I'm building my wealth every day. And my message is just, go out there and do something. If you do something, you get something. If you do a whole bunch of nothing, your life becomes a whole bunch of nothing. And then especially like the people that you hang around with. When you hang around with people that are doing nothing, guess what? You end up doing nothing too. So my message, my overall message is always get out there, start building your wealth, starting to increasing your life, get some passive income. And if you want to get to a point where you're reaching financial freedom, and if that's a goal of yours that you want to do, like myself, then get out there and start today. My overall message is just to get out there and just do something and do something towards improving your life every day.
I give you a lot of props, I think you speak from a very honest place when you talk about how your father's passing was a big catalyst for you, as I think was typically the case with tragedies, especially at a younger age, as a child. I'm curious, did your father was not into investing, certainly in the way that you are now? What was his own approach? You actually was saving, but presumably he was still doing some kind of other investing or trying to generate wealth in other ways.
He was a very hands-off guy. He wasn't very into the whole investing deal. He was the guy that just had it taken out of his paycheck. He was a teacher too, and just have it taken out of my paycheck and set it and forget it kind of thing. I'll collect my pension when I'm 65. So he didn't really have much knowledge about investing. He didn't blow money. He was more on the frugal side, but he did not know anything about investing, or maybe he just led us to believe that he did. But he never talked to us about it. But my dad was not a very big risk taker at all. He was not at all. He was a very conservative person with money, and he'd much rather have that money in his hands than anywhere else that has a risk on it. So that was the environment that I grew up in. And that was, I thought that at the time, I thought that was better than, having somebody around me that was blowing our money and was riddled with debt and that we were struggling really, really bad. I'd rather have the scarcity mindset. But then, I was a 31-year-old grown man that didn't even know what an index fund was.
Talk about just some of the things that you would do to learn. So I get a YouTube podcasts, right? But I mean, were you going to certain dividend focused books? What was your own self journey like? I come from having studied finance in college and then making this my career and reading all kinds of books when I was younger. But I was also surrounded by it. In my case, my father was in the business. when you don't know much about what you're getting involved in, how do you structure, a regimen to get you to understand what's really happening in this side of the business?
It was hard, Michael, and I didn't have any of that background, and I wish I did, but I didn't. And it was hard, man. I had to figure out everything on my own, literally everything on my own. I had to make sense of it. And, I like to consider myself a somewhat smart guy. It kind of came to me and I started putting everything together. And what I would do was I was so diligent, man. I would watch videos. I would read articles. I would watch lives on Instagram and, I would go into investing groups on Facebook and I would just bother people and I would just send messages. Hey, can you tell me what this means? Hey, can you tell me what this is? The influencers that I was watching on YouTube and all these guys, I'm sending them messages on IG. Hey, man, I saw you said this. Can you tell me what this is? Hey, yeah, 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 yeah. Hey, did you see this? Hey, what do you think of this? And I was like a pest. And that's what I did. And then I just started putting it all together, little by little. And then I would, like I said before, I would dip my foot into the pool a little bit, buy a share. I would research another company, buy a share. And that's what I did. But I literally just dedicated myself to that process for a good year and a half. Just nailing it home. Any opportunity that I got, I was learning. And there was no real order of operation here because I had no clue. So it was kind of just like I learned as I went and as I heard things. Okay. Oh, he said Roth IRA. What is that? Go into the old Google machine, put it in there. Oh, this is a Roth IRA. Oh, what's a REIT? Okay, I don't know what's a REIT is. Real estate investment trust. Let me learn about that. Oh man, they have 90% of their net income has to go back to the shareholders. Maybe I should look up some REITs to invest in. Hey, I use this shampoo a lot. Let me look in the back of this bottle. Oh, Johnson & Johnson. Let me take a look at them. So that's what I did. But I literally, I'm not going to lie to you. I obsessed about it for a year and a half and I learned everything that there could about dividend investing, personal finance, and you could throw the real estate in there as well.
Yeah, and the challenge there, of course, is that like you don't know if when you're just starting that journey, you don't know if what you're listening to or watching is coming from somebody who actually knows what they're actually talking about, as opposed to having a well produced video, right? Like on YouTube. And like I've seen that all over the place on YouTube. These videos about how to get rich quick with different investing styles, and you know, I can understand why it's appealing for a lot of people, but especially if you don't know much about this side of the world, right? It seems, that sounds like it's logical, but being able to filter out the nonsense is the hardest part, I would think.
Absolutely. That was the hardest part. Like I said, I had to put it all together by myself. So it was hard to really identify who was full of you know what and who was giving me quality content. But what I did was I tried to put together things that I saw commonly. So if I saw the same thing more than once from more than one person writing about it or talking about it, I knew there was something that I needed to dive deeper into. I remember I was listening to a podcast on Bigger Pockets, and they were talking about cash out refinance, talking about mortgage loans and investing in real estate. And I dove into that and I learned about different mortgages and how to maneuver those things. So when I had my rental property, I knew exactly what I had to do. I just kind of just flowed with it, dude, and just let it come to me. And same thing with anything else. The more time you spend with something, the better you get at it, right? It's like riding a bike. If you ride a bike every day, after a year, you're pretty damn good at riding that bike. So that's kind of what I did. I just dedicated every day, and I constantly kept myself in this state of learning, accumulating information, and just where's the market? Like state of the market was always on my mind.
Since you're in the education system and this family history there, I'm curious, why is it that you think that the basics of investing aren't taught earlier? I mean, you're in it, so you know what the education system is. I mean, I'm always blown away that it's not mandated. I mean, I understand it's home economics, but it's not mandated almost like on a federal level that basic understanding of investing and financial management needs to be taught at a very young age.
Yeah, it's a shame, man. It really is. And take it from me, I'm an educator, and I see it every day. And it's not there. I know some states are starting to adapt. And they're starting to incorporate some things as far as graduation requirements and having kids take some courses. But it's a shame. I mean, it's a flawed system in a way because the education system is, I would say, it's an older system, and and there's that aspect of society that they're almost educating us to be workers, right? They don't teach you how to be an owner and how to own assets and get on the other side of the equation. So it's a shame that we're at that point, and it's almost hard to believe, right? 2023, where you got 18-year-old kids making millions of bucks through drop shipping on the computer, and you're not teaching a kid how to manage their taxes in high school. I mean, it's kind of backwards, but that's where we're at with society. That's the story. So we gotta hope that in the future something changes, but that's the story, man. That's how it's always been, and I don't know if we see anything change in the not too distant future.
Any thought to sort of you getting more involved on the education side formally? Yeah, this is the way it is, but you're in a unique position because you've done this yourself. You're self-taught. You're on the education side, like you mentioned. I mean, why not try to do courses or try to teach local kids or your own students, right? I mean, any sort of thought on maybe that being a sort of a next natural step for your own career?
I'm not sure, man. I'm not sure if it would go that way. I would definitely be open to it because I love teaching and just overall, I love educating people. So I would definitely be open to doing something like that for sure. But like you said, it's a really hard thing because we want better and we want our society to grow as we grow as people. And especially today, man, in today's world, you can figure this out on your own, just like I did. You can figure out the blueprint to be a millionaire anywhere in the United States just because we got all these resources out there. But it doesn't happen without your effort. So you got to get in there and you got to want to do it yourself. But that's what I mean, man. I wish it was a little bit more formal as far as our education. But nonetheless, we got opportunities out there that blow away any opportunity they can give you at school, right? In my opinion.
What do you think people get wrong, or maybe what was the thing that as you were in the early stages of learning, you thought was right, but then the more you learned, you realized was actually the wrong way to think about dividend investing? There's always sort of an aspect of self-learning where you go back to what you learned in the past and say to yourself, you know what, actually the way that I thought about it back then wasn't really accurate.
Well, I made a lot of mistakes in the beginning, dude, because I was learning and I was so eager that I took a lot of action. And with that action, as a greenhorn, as a young man, as a young investor, I made a lot of mistakes. And I bought high yields because I saw a high yield on the number, and that didn't turn out well. So I made that mistake. But overall, what I would say, and I'm always transparent about this, and I always say, if I knew what I knew now about real estate and about how leverage works and how that could be so beneficial to building wealth, if I knew what I do now back then 5 years ago, I would have started the other way. I would have started in real estate first, and then I would have funneled the rents and profits from real estate into the stock market in the form of dividends. So I would have done it the other way around, but I'm totally happy with what I did and how it is right now because I'm still able to manage my career and do that whole deal too. Things are the way they are now because I'm happy with it and all good on that end.
Nick, for those who want to track some of your content and learn more about dividend investing from you, where would you point them to?
Yep, you can always check me out on my Twitter. That's probably the most active I am on the social media platforms. My handle is SmartNetWorth1. Go check me out there. Send me a DM. Say what's up. Tell me about your journey with passive income and reaching financial freedom. If you hit the link in my bio, you'll see some of my digital resources there. There's some cool things there. I have my newsletter that I update all my buys and everything that I'm looking at as far as the market. That goes out on a weekly or bi-weekly schedule. And yeah, that's pretty much it, man.
Good place to wrap this Twitter space up. Everybody, please support Nick and follow him on Twitter. Again, this will be an edited podcast in a couple of days here, and hopefully I will see you all again soon. Thank you, Nick. Really do appreciate it.
Thanks, Michael. I really appreciate you having me on. Thanks so much.
Cheers, everybody.